Trading penny stocks can be an exciting way to gain exposure to stocks that are not on major exchanges. It can also be a great way for new investors to get their feet wet and learn the basics of stock trading. This will provide a very basic overview of what penny stocks are, how they trade, and some key considerations when trading them. What are penny stocks? Trading penny stocks is a great way to get involved in the stock market with just a small amount of money. With the right strategy, you can make large returns on a small investment. We will discuss the basics of penny stock trading, including how to identify good opportunities, use technical analysis tools to analyze price movements, and create a trading plan. We will also discuss the risks associated with penny stock trading and how to minimize them. The basics of penny stock trading. Penny stock trading has a few basic steps. 1. Identify a penny stock for purchase. Investing in penny stocks can be an exciting and rewarding way to build a portfolio. However, it is important to identify the right penny stocks for purchase in order to maximize returns and mitigate risks. Identifying a penny stock requires research, as well as the ability to distinguish between financially sound companies and those that are not. What is a penny stock? A stock in the United States that typically trades under $5 per share and has low liquidity or no daily trading volume. The trading price of these shares can fluctuate significantly on a day-to-day basis, resulting in potentially large gains or losses for investors. A company with low sales and a high debt-to-equity ratio is often classified as a penny stock by brokerages who provide research on securities that are not considered blue-chip stocks by other institutions. What makes a penny stock so risky? Penny stocks are cheap and have low liquidity, meaning they typically trade infrequently and only occasionally, making them difficult to sell in large quantities. Penny stocks are also more volatile than other stocks. That is, their price can change significantly from day to day. Because of their riskiness and volatility, investors may be tempted to buy penny stocks when they fall below their purchase price, because the chance of a quick return on investment is possible. 2. Do research on the company and its financials. When considering an investment in a company, it is essential to understand the company's financials. Doing research on the company and its financials can help potential investors make informed decisions. It can also provide valuable insights into how the business is performing and what kind of future growth potential exists. Financial information provides a deep understanding of the current state of a business, which can be extremely beneficial when making important investment decisions. The financial information of a company is developed from its own financial statements. These are the documents which are compiled by accountants and provide information about the company's past and present performance. The documents include the balance sheet, which provides a description of existing assets and liabilities of the company, the income statement, which provides an explanation for how much money has been made in profit or loss for the year, the cash flow statement, which explains how much money has been brought in and spent over the course of a year, the statement of changes in equity, which offers an explanation for the change in ownership between shareholders. Companies create financial statements and take them to accountants to be reviewed before they are released. Financial statements are known as 990 forms because they are filed with the Internal Revenue Service, IRS. Companies have 3 years before they must file their financials. 3. Set a stop-loss order to limit potential losses in case the stock drops suddenly. Before investing in penny stocks, it is essential to set a stop-loss order. This order serves as an insurance policy that helps investors limit potential losses if the stock suddenly drops in price. The stop-loss order helps investors avoid emotional decisions and maximize their profits while minimizing their risks. It is a key risk management tool that can significantly improve the overall performance of any investment portfolio. Example of a stop-loss order. Investors wish to buy $100 worth of a penny stock, but set their limit to sell at $80. If the stock falls below $80, the order will automatically be executed to sell all shares. Investors wishing to buy penny stocks can be susceptible to trading too many shares in a short period of time, which could lead to market swings that are not always desirable. The stop-loss order is an important tool investors can use to manage this risk and limit their losses. Set the stop-loss order at a price you believe will be at or near the most likely price during the time frame of your anticipated investment. For example, if an investor anticipates investing in a penny stock that has had some volatility, they should set their stop-loss order for $50 in case it drops below that. If the stock soars to $100, then their limit would be set at $75, and so on. This helps avoid losing money due to market swings due to overtrading or making decisions based on emotions. The stop-loss order allows investors to minimize potential losses while still keeping a long-term perspective. The long-term view has been shown to outperform the short-term view in a variety of areas, including investing, politics, and sports betting. However, investors need to be aware that the stop-loss order is largely meant for short holding periods and does not have strong tax implications. There are some tax implications that can come with stop-loss orders for traders who sell securities, which can impact their capital gains and losses, but it should be noted that this rule only applies to traders who consistently trade in stocks more than once every year. If a trader's trading is less than once a year, the trading strategies should not be affected by this rule. In the case of an asset bubble, risk tolerance depends on how much money an investor has available. The lower their resources, the more risk they are willing to take. Conversely, if an investor has adequate resources, such as a large amount of savings or wealth accumulated over time, they can afford to take more risks with their investments, depending on how confident they are in their choices in selecting securities. Goal-seeking investors who have minimal resources may be inclined toward passive investing, while those who have significant wealth and capital may pursue active management. 4. Monitor your positions for changes in price and act quickly to take advantage of price movements. Before investing in penny stocks, it is important to monitor the prices of the stocks and act quickly on any changes in their price. This is because penny stocks are highly volatile and can move quickly in either direction. With careful monitoring, you can take advantage of price movements and maximize your investment returns. The great thing about penny stocks is that they are cheap. Cheap means a high return on investment, and many investors like to buy penny stocks because they think that their price will rise in the future. The price of a stock can be determined by how much demand there is for the company, or how many shares are currently selling. The high risk involved with penny stocks makes it important to use contracts or options when investing in these types of stocks. Contracts and options can help to protect your investment as you wait for a change in market conditions before making an actual purchase. Thank you for watching.